Good morning, good afternoon, everyone. Thanks again for joining our first quarter analysis of the NCREIF ODCE Index call. This is now, I believe, our fifth call, so we've been doing this over a year, and we have about 400 participants. So again, welcome everyone, and thanks for attending. Just a quick reminder: the performance information that will be shared on this webinar is the entire ODCE index, so it covers all 27 of the ODCE funds. The valuation data that we talk about is reflective of not only the 25 ODCE funds that we work with, but then also insights on the more than 12,000 valuations that we oversee each quarter on assets totaling in excess of $1 trillion of gross asset value. Again, we'll have some time at the end to answer any questions you may have, so feel free to submit any questions in the chat feature on the screen, and we'll address those at the end. Also, a quick, just a reminder to mark your calendars for Thursday, August 4th. We'll have our next call covering the second quarter results. And so before I pass it off to Phil and Robbie to run through the topics, I want to just talk about or mention some of the things that we'll be covering, some of the topics we'll be covering this quarter. And it really is driven by the questions we get in conversations with our clients or other people in the industry. And some of those topics include, has the market peaked? We're now, after several quarters of just phenomenal record-breaking growth in the ODCE index. And so question is out there, has the market peaked? Have yields bottomed for industrial and key gateway apartment markets where we've seen, especially tremendous returns in those markets? Impact of inflation. We're seeing I think we're now, the transitory word is out of our vernacular for when we come to inflation. So what has inflation and higher interest rates done to first quarter returns? How much of the appreciation is now related only to cash flow, and therefore how much is no longer attributed to yield, changes in yield? Growth sectors, are we continuing to see strength in those sectors? Retail office, which hasn't seen the similar amount of growth as industrial apartments. Are we starting to see a rebound in those markets? And then finally, the gateway markets. Are we seeing recovery? They've been hit because of the pandemic and the slowdown. And are we now seeing, now that we're seeing return to the office, are we seeing recovery in those markets? So for answers to all of those, I'll now pass it to Phil and Robbie, and then I'll come back at the end with any questions that the participants have. Phil?
Thanks very much, Rick, and thanks everyone for joining the call today. Special thanks to everybody that's part of the wide data exercise, both across our clients and obviously also internally. There's a big effort collective to get all this information turned around within what is a relatively short time span. So hopefully it's useful to get an early sight of what these returns are shaking out like. So just to set out what we'll be reviewing, this presentation focuses on the pure real estate part of the ODCE. So there's no leverage, no cash, no fees in terms of what we're talking about, looking at how actual performance levels are played out. And as usual, starting off with the headline returns, this is income and appreciation. And first goes just kind of stopping where the market was at the back end of last year, obviously closing off, as Rick mentioned, exceptionally high rates of return. And as Rick mentioned, the questions that we've been getting from kind of investors, managers, wide practitioners in the marketplace is whether the market had reached its peak back in Q4. So just without further ado, there's the numbers for Q1. So Q1 produced another strong set of numbers. That's that 6% rate of return there. That may not be quite matching the growth of the final 3 months of last year, but it's still exceptionally strong nonetheless. 6% for the overall quarter gets scaled back to 5.7 on a pure operating asset basis. So the inclusion of developments is effectively adding about a 30 basis point premium performance level. So returns down on where they were in Q4, but still ahead of where they were at the levels in Q3 of last year. And when you compound each of the last 4 quarters, and 3 of those are in the upper single-digit territory on an annual basis, returns continue to rise, posting up there at 23.8% for the last 12 months. This table backtracks to the early part of the pandemic. midway through 2020 was when returns turned negative overall. Since then, the market's been firmly fixed on an upwards trajectory, and as Rick alluded to, hitting kind of record rates of returns in recent quarters, all of which is making the kind of downside of the pandemic increasingly feel like a distant memory. But there's a lot of variances within these overall results, which hopefully, with the assistance of Robbie, will unravel over the course of the next 40 to 45 minutes. I've color-coded first off here just the sectors to highlight the variances through the pandemic. Logistics kind of clearly much talked about, the major beneficiaries, that swathe of green that runs through the middle of this table. That's largely at the expense of the retail sector. And that's a trade-off that was in place, but has certainly been exacerbated during COVID. And the market really does remain incredibly one-sided if you just look down that kind of Q1 22 column. It's only really in green the industrials and other, most of that is self-storage, which are ahead of the that stabilized overall average of 5.7%. Everything else is coming in sub that number. So retails and offices languishing at the lower end. Apartments pretty close to market at 5.6%. Apartments and apartments and offices started off with similar setbacks when you go back to Q2 2020, but apartments have certainly emerged on a far stronger footing. Returns there have really started to pick up in the second half of last year and continued in that vein start of this year, and actually on an annual basis, it's on a return 24.2. That beats the overall ODCE stabilized return of 23.1. If you focus specifically on the movement through to the first quarter, it's worth noting that apartments, industrials, the stronger sectors, returns there have all eased off during the first 3 months of this year. Retails have made progress; their returns have edged upwards, whereas offices, a sector shrouded with uncertainty, which has actually dropped to the bottom end of the order now, has not moved any further forward returns wise. This returns kind of matching up with where they were at the back end of last year. If you stretch things back and you separate the kind of the period of the pandemic, let's call it, into its two halves onto an annual basis, then clearly all the damage was done in the first 12 months. If you look at the returns over the last 12 months, it's been characterized by, I'd say, stability at the lower end of the order. There's 5.7% returns for offices, 6.4 for retails, and then some record numbers on the growth sectors. So, topping 50% for industrials, over 30% for other, and as I say, apartments are ahead of the ODCE overall. So all that kind of stacks up that near 24% rate of return for the last year. But whatever period you cut these numbers by, this all shows that this is a time of kind of huge disparity. We've used that word before, where allocation decisions by investors are really having quite a meaningful impact on their relative performance levels, and that's the kind of detail we get into on the one-to-one analysis with the portfolios that we're working with from a performance analysis standpoint. And it's not just the sector variances shown here, but it's variances within the individual sectors, which we'll get into the detail of. The next chart unpacks the returns into their kind of income and appreciation elements, helping put the current performance trends there on the right-hand side into an historical context and possibly illustrating how the market may have passed its peak. But let's not forget that real estate really does continue to strengthen. So those returns may have dipped off, but I mean, values are very much still on the rise, and that appreciation return of 4.7% is really only eclipsed by the rally in the final 3 months of last year. And what we've seen in the last 3 quarters really overshadows the write-downs that occurred through the initial part of the pandemic in 2020. And it's been a really rampant recovery. And within those overall numbers, let's not forget that the market is still paying out a quarterly 1% income return to investors. So that's clearly an attraction to investors. Before I put the question back to yourself, Robbie, about whether these growth rates can be sustained, I first just want to unpack these appreciation numbers. So what we're able to unravel at Altus with our kind of market-leading valuation data set that Rick was referring to at the start is just how much that value change is a product of kind of the pure economic fundamentals versus kind of the ongoing investor sentiment. So we're on this next chart, we're taking the red bars here, transposing those onto the red line, and then bifurcating that appreciation into what's termed the yield effect, the yellow, and the cash flow effect, the blue. So the yield effect is the impact of what might be termed pure pricing levels on value. So the impact of changing discount rates, exit caps, that's the investor sentiment, the capital markets part of the equation. For the cash flows, the blue bars, we're identifying the impact on value from the change in those forward projected cash flows, and that's more the kind of occupier demand versus supply fundamentals side of the equation. We can unpack that into even more detail in a few slides' time. But in terms of the headline numbers, the slight easing is on both the yield and the cash flow side. A little bit more of a tapering on that pure pricing side, the yellow versus the blue, but it's kind of hard to really call out an audible, say, calming of investor sentiment at this stage based on certainly those yellow bars. And that blue bar is again really only beaten by the record levels that we saw back in Q4, added to which we've often seen a bit of a seasonality in the spike towards the end of a year. The grey bar, that just to call that one out, is the third layer of the appreciation piece on value change, because you don't bank all that change in value from a return standpoint. So the appreciation of 4.7 is net the amount of money that's spent on properties during the measurement period. So that takes 20 basis points off. But kind of if you just leave that to one side for now and focus on the interplay between the blues and the yellows, taking the narrative back to the start of the pandemic in 2020, it's a reduction really, and we've talked about this before, the reduction in the cash flow levels that took values south during the onset of the pandemic. The recovery was then initially kind of investor driven, and that's those yellow bars, and that's still very much in evidence. The market fundamentals, those blue bars, have then now become the leading component of growth. So put into proportional terms, and to maybe answer one of Rick's questions up front, it's now a kind of 70-30 split between fundamentals versus capital markets driving up those values. So we do still have that kind of perfect storm of kind of ongoing investor sentiment, continued strengthening market fundamentals that is effectively pushing values to record new heights. But Robbie, maybe over to you in terms of your read on maybe how long these growth levels can be sustained, especially kind of taking on Rick's point there, especially when you throw into the mix the rate increases by the Fed. How much might that have impacted on these current numbers, but more crucially, I guess, going forwards?
Thanks, Phil. I think one of the main questions a lot of people have, what is the impact of rising interest rate, right, to the cap rate and therefore the value, right? So if you look at historically, the cap rate generally have a poor correlation with interest rate. They're actually much more dependent on capital flow, right? So, but how do we measure capital flow, right? So one thing we're trying to kind of look around is what is capital raised in real estate, right? So capital raised in real estate in 2022 been very strong, right? So that's following a very strong 2021 year, right? So if you look, it's one of the strongest on record, right? So depending on which report you read, it ranged from 100 billion to 300 billion in 2021, right? So granted, majority as a closed-end fund, right? So closed-end fund do raise a bulk of it, but that's followed by non-traded REIT, right? So non-traded REIT also seeing a significant momentum as well in 2022, right? So the fund have been raising more than what they can place, right? So at the result of it, the dry powder is basically reported all-time high as well, right? So you get 200 billion of dry powder out there as well, right? So adding on the last couple the last year, the last couple quarter here, right? So basically the uncertainty with stock and bond to some extent, right? So that volatility on stock and bond, people know the interest rate going to go up, so the basic allocation to bond might reduce, right? That help to private real estate, right? So on the other hand, basically the stock and bond declining, if it continue to decline, might put a little bit pressure on because of due to denominator effect, right? So at some point it might kind of limit some of that flow side as well. The other thing to consider is the higher interest rate actually do inhibit some of the leverage buyer, right? So with the high interest rate compared to where the cap rate is, right? So it's not accretive on all the deal anymore, right? So, but overall, as of now, investor demand on real estate remains strong.
Okay, thanks, Robbie. And also, obviously, what we're looking at here are all property averages. The next slide shows the need to investigate the individual sectors and how these feed up into these overall levels, and very different sets of circumstances playing out. So here you want to be focusing on the right-hand side of these charts. I've shortened the time series so we can get zero a little bit more on the period of the pandemic, but still with some historical context. So, and we've kept the scaling uniform across these four charts just to showcase how much of the narrative is being kind of dwarfed by what's been going on in the industrial sector. So let's start with the industrials there on the top right, and the slight easing for industrials is more on the pricing, those yellow bars, and the cash flow side of the equation. So I guess back to you again, Robbie, do you feel that the intensity of the bidding war for the industrials is coming to an end? Are you hearing signs of that cooling off at the moment?
Yeah, so we definitely heard there's less bidder in some of the low cap rate transaction, right? So being granted, the bid are still very competitive, right? So just number of player going into the bid might be less, right? So if you kind of look at it, the unleveraged buyer pretty much out, right? So if you look at it, the 10-year treasury have moved up from beginning of the quarter 1.5%, at the end of the quarter it's 2.4%. As of today, it's past 3%, like close to 3. It's I think 309 earlier when I look at it, right? So if you look at that, you add on 150 to 200 basis points for leverage, right? For mortgages, you're talking about all-in interest rate 4.5% to 5%, right? For industrial, right? So, and many of the bid basically in the Southern California Inland Empire area is very aggressively priced, right? So you look at it cash on cash basis over 5 to 10 year period, you're looking at 3% to 4%. That 4.5 to 5% is not going to be accretive on a cash flow perspective, right? So granted, if you look at on the whole with capital gain appreciation here and there, it might be accretive on number of equity you have to put in, but during the cash flow you're holding it's not accretive, right? So it takes some of that leverage buyer out from the equation. So that's the first time we talk about the headwind on industrial, right? So we always talk about the tailwind all the time in industrial. That's the first time I talk about it, right? So some headwind. The tailwind is still strong, right? The fundamentals not a question here, right? So with Ukraine invasion, COVID shutdown, a lot of people asking what's the impact here, right? So with all this happening, people feel, okay, inflation is definitely going to stay longer, right? So it's going to be more stubborn. Supply chains, originally people think going to abate over time. It's not going to abate over time. It's going to continue to be an issue longer as well, right? So when that happens, the tenant also fear of missing out, right? So they have to prepare for this year kind of holiday season here and there. So they all have to increase the overall stock, right? So and they're going to sign every leases out there available, right? So that's why you fundamentally on the rent side, you're seeing that rent continue to go up just because there's not a lot of industrial space out there. And then you can see that as well in public industrial REIT. The last couple of weeks, there's a lot of report on public industrial REIT. They're all showing big rent increases, right? So they're all showing great earning, right? So a lot of large lease spread is like I heard 20% to 50% on some cases, depending on the location, right? So again, no one's questioning on the fundamental side. So now the question is a little bit more, what's the capital market will do on this cap rate?
Sure, and I guess that plays into that blue bar there, the growth in cash flow levels. I mean, pretty much keeping pace with where things were at the back end of last year, and certainly more of a kind of cash flow make up the overall appreciation returns. And I think that's an 80-20 split between cash flow to pricing. Let's substitute out maybe the industrials for other, put that in its place, and that actually now allows us to rescale these charts. So it makes it a little bit easier to identify the trends across the other sectors. The scaling back on appreciation in other, which is mainly storage for this last quarter. That's both on the yield and the cash flow side. More of a kind of 75-25 split between kind of cash flow to pricing. So again, taking on more of that cash flow tilt. Whereas if you move across to the composition of appreciation for multifamily, that's more evenly balanced. It's almost kind of 1 part yield, 1 part cash flow. And it's the cash flow aspect that's really been tapered off in the opening 3 months this year, whereas there's really been no let up in the kind of pure pricing side of the equation in terms of the impact that pricing adjustments having on appreciation. So maybe, Robbie, just your thoughts on the makeup of that appreciation return for multifamily there.
Sure, I think the investor demand are still strong for multifamily, right? So people still believe the rent's going to continue to go up, but there's some seasonality aspect to it, right? So if you look at the first quarter valuation and you look at the data, just pretty much after the holiday season in the winter time, there's usually less move in, less move out, so that the rent's typically not as strong in terms of growth perspective, right? So that's why I kind of look at the aspect is that cash flow reduce a little bit, right? So but the investor demand are still strong, as you can still, the yellow bar still remain there pretty strong.
Sure. Okay, thanks. And then moving down there to offices, which I guess by comparison have just really just stuttered along. I mean, positive appreciation though in each of the last 4 quarters, mainly only the slightest upturn in valuation metrics, but gains nonetheless. When if you look in the detail there on both the yield and the cash flow side in each of the last 4 quarters. However, these are overall levels, and that masks a ton of variances across regions and more localized markets. We get the detail a little later in the presentation. If you continue then round to retails having gone through this kind of torrid period of correction, but the sector now definitely feeling like it's moving in the right direction. Q1 saw a positive swing in both kind of pricing and cash flows. So those green shoots really starting to begin to emerge. And but again, a very different narrative that gets played out across different subtypes that we'll get into the detail of. Let's take a deeper dive into the appreciation breakdown. So here we're just ranking the sectors, as we've done previously, in terms of appreciation for the last quarter, decoupling the yield and the cash flow effects. The top to the bottom end of the order are kind of very much separated on both a yield and a cash flow perspective. It's almost a case of the haves and the have-nots when you're contrasting the bottom two with the rest. Everything though is sitting to the right-hand side of these lines, although minimal gains in the case of retails and offices. Industrials very much leading from a cash flow perspective. Apartments seeing more of that positive pricing adjustment in the opening 3 months of the year, but most of the variant is between the different food groups is on the cash flow side of the equation. So let's pick that apart and what we do on the cash flow side of these metrics here, we relay those through to a series of 6 key valuation metrics. I mean, it's not all encompassing. There's no perfect science to this, but the color coding gives you a sense of what's having a positive or negative impact on those kind of changes in those forward projected cash flows. And this is the type of insight that when we're analyzing individual portfolios that subscribe to our performance analysis services that get access. So if you're interested in this type of analysis, do get back in contact with us. What we're showing is the percentage changes on each of these metrics over Q1, and it's predominantly greens across the board. The reds, I'd say, are more on the actual outgoing. So here, that year one operating expense ratio, which is measuring the change in year one projected operating expense as a percentage of the gross anticipated rent over the course of next year. And generally, we're seeing headwinds here linked to the wider inflationary stories. Costs are starting to typically escalate. I mean, at the earlier part of the pandemic, the net deficit that we were picking up on this metric in terms of the reduction in the near-term NOIs was more about kind of revenue reduction, rent concessions, but now it's more about cost escalations. Actually, on the retail side of things, digging into this one in a little bit more detail, the fact that that's kind of trended back down, it's more about the fact that those kind of rent concessions are now starting to kind of unwind and kind of mitigate some of those kind of increases in costs. We also noted on the outgoing side last quarter that it's interesting to draw attention to this metric here, which is the capital expense ratio, and this tracks the budgeted capital cost as a percentage of value and how much that budgeted capital cost has changed over the quarter. And this has been edging upwards in the case of retails, but even more so on the office side of the bottom there. And I assume evidence of how investors are kind of realizing a need to invest more into these assets to ensure they kind of remain competitive in the wider market space. And for offices, that's certainly been keeping in check any value recovery at the moment. But the main variant from top to bottom is is more on the revenue side, and you can see that playing out in those changes, those deltas and movements on those face market rents. Industrials very much leading the way in terms of the changes in market rents, and those levels of increases reducing as you drop down the hierarchy from apartments, retails to pretty negligible on the office side of things. But those market rents are improving over the quarter, as are those projected rent growth rates. These are changes in growth rates on a 10-year basis. So less of an improvement in the case of the offices, larger gains for retails. That kind of initially may jump off the page, but these are coming. Remember, these are coming off a lower base, but still quite a notable swing for the one quarter. And so that's a 10-year rate. So let's open that up on a year 1, 2, and 3 basis. So those improvements, those growth rates, are, as you most would expect, are mainly in the year 1 rates, but positive adjustments also to year 2, a little bit less so in year 3. The bars here show the change in those growth rates from where they were at the end of last year. But I've also actually could put the numbers there as well, so you can get a sense of the levels of growth that are being priced into the values. And if you cast those results back over the last 2 years, then you can see that offices, retails, those year 1 levels of 1.8, 2.1 are still below where they were 2 years ago. And remember, this takes things back 2 years, so it takes it back to Q1 2020. So we're actually missing some reductions that are associated with that initial 3 months of the pandemic. That's maybe why that kind of retail 10-year average is a little above. If you ran that back to December 19, then that would still be net below. At the upper end of the order, those near-term growth assumptions have really strengthened quite considerably. So you can see that kind of 5.5 rate for industrials, and how that's strengthened by about 2 percentage points over the last couple of years, up to 4.7% in year 2. Apartments over 2 years, those year 1 rates have kind of gone to the high 3s. They're also in the high 3s on a 2-year basis. And these kind of changes in rent growth rates, along with the adjustments in those market rents, are what's really feeding into that overall variant on the cash flow side, which clearly marks out the contrasting fortunes between offices and retails, net down, and everything else. And when you factor in for offices and retails the increase in that kind of cost to revenue ratio, part of which is encompassing the increased kind of cost, but also still some rent concessions and the added budgeted capital that's coming through over the last couple of years, then that you can see that's really what's holding back appreciation in those 2 sectors over the course of the last couple of years. But this does clearly mask a whole host of variations at a regional and a subtype level that we can now step into the detail of. So let's go back to the last quarter and back up to the actual return levels, which you're showing here across the major metropolitan markets. So just to explain, the color coding on the top table here, these are all total returns, income and appreciation. That's that 5%, 5.7% ODCE kind of stabilized rate of return for the quarter. So anything north of that, accretive to the overall ODCE index return, is in green. Anything south of that is highlighted in red, and it just goes to show the divide that's out there in the market. Industrials all the way across there in green. Apartment sector, there's obviously the divide there, mainly between the sun belts and the gateways, but a good assortment of some greens in there as well. And on the other, which is mainly storage, more greens than reds across the board, and there's definitely an alignment between the greens at the top, between the multifamily and the other sector. Offices and retails, all in red, pretty much. And so switching the color coding up on the next, then we're now showing how these individual metropolitan markets perform vis-a-vis their sector averages. So focus on that DC industrial, that's 9.1, that's positive in the context of the overall ODCE, but when you relay that in the context of the wider industrial market that delivers 11.5, that turns red. So that gives you a sense of what the upside and the downside is now within the individual sectors. The bottom table then just shows you how the returns for Q1 compared with Q4. And here we're now seeing a lot more red on the board than we've seen it in prior quarters. So another possible indicator that return-wise the market may have passed its best, so to speak, culminating in that overall kind of 90 basis points dip in returns over the quarter. But let's take each sector in turn, and Robbie, bring you back into comment on how the themes are playing out across within the individual sectors. So let's take apartments first and highlight those up. So again, and this is quarterly, just to stress again, the lead performers are the Sunbelt markets, the likes of Phoenix, Miami, Atlanta at the upper end of the performance rankings. Contrast that with gateway markets of San Francisco in the red, Chicago in the red, and actually you can see how those returns have changed. Those returns have actually kind of dropped away in the first 3 months of the year by 1.1, for Chicago almost by 2 percentage points. By comparison, take another gateway market, New York, posting a bit more of a recovery, 4.6. It's still short of the sector average, but 4.6 is up 1.3%. So definitely something different happening on that New York market versus what's occurring in the other gateways of San Francisco and Chicago. So Robbie, we've talked about this. Do you get a sense that maybe there's that gradual kind of move back to working in the office that's maybe starting to have a little bit more of a positive tilt on that New York gateway return versus what we're seeing in San Francisco, Chicago, and maybe also just general comments on the wider trends that are still being played out on the multifamily side?
Sure, and do I look at that? There's definitely has some correlation, right? So the impact of the office return, right? So on the CBD side. So if you look at it, San Francisco is actually struggling with return to the office, right? So they just recently passed 30% utilization. I think now like low 30% based on the Castle system indicated, right? So versus the Texas market, they're already in the 50%, right? So and US 10 major cities usually average about 43%, right? So San Francisco is actually lagging on that perspective. New York is in the high 30s already, right? So they're actually kind of doing better than San Francisco. Chicago is actually doing good as well. The only thing is Chicago have a lot of supply, right? So I think that while the return office is good, they have a lot of supply in Chicago. Also that typically have a net migration out still in Chicago, right? So generally there's always a net inflow. If you go to the next chart as well, Phil. So in here as well, kind of the other thing as part of the return office, a traffic recovery do kind of show as well why San Francisco is lagging, right? So yeah, San Francisco actually still pretty far off from kind of where the 2019 number, right? So versus New York, kind of like Miami, Phoenix, they all kind of in a sense closer on to the 2019 number yet. So that the overall recovery show why San Francisco is lagging.
Oh, thanks, Robert. If we just delve a little bit deeper into those variations, so just here for Q1, we're taking the appreciation element of the return on the left-hand side there. So values are up in all metro markets, San Francisco and Chicago included, but the increases there are pretty minimal down the bottom there. Every market is seeing some form of positive pricing adjustment, less so on those bottom two. But cash flow is really the main differentiator in terms of this hierarchy, in terms of appreciation returns. Now, there's not a great deal of relationship when you look at change in contract rents, but if you look at the change in the market rents, it's those Sunbelt markets at the top that are seeing the larger market rent increases over the quarter, and you see a broad correlation as you do step down the overall hierarchy. And just back to that New York point, kind of highlighting that up, and I've actually substituted out there the contract rent change to the rent growth adjustments, and New York seems to have kind of marked itself apart in terms on the upside in terms of the rent growth improvements that we've seen over the course of the last quarter. So on a 10-year basis, that's up 11 basis points. So actually one of the larger movements across any of the metropolitan markets. But caveat that with the fact that they got ratcheted down more during the initial part of the pandemic. So maybe playing a little bit of catch up in that regard, but certainly starting to move away from Chicago and San Francisco, courtesy of that change. we look over the 2-year period, the variant between the top to the bottom place markets and those cash flow trends are even more accentuated. Over 2 years, remember this is, so remember we're dropping off the first 3 months of the pandemic. So those bottom 5 from a cash flow perspective are pretty static and in decline, and there would be more downside if we took this back a full 9 quarters. But there's definitely a kind of clear divide that's opening up here between the sunbelts and the gateways over that 2-year time frame. If you look at market rents, contract rents, clear gains up top versus minimal increases and net deficits in terms of market rents and face contract rents from where they were. And obviously, again, this is missing off the first 3 months of the pandemic. Let's move down a row now down to the industrials. We boarded those up. First point to mention when you're thinking about the industrial sector is really just looking at those changing returns versus where they were in Q4. So most of the metropolitan markets easing off in terms of their industrial return levels. It doesn't change the hierarchy a great deal that we're seeing on that top table, in that it's still the Southern California markets that are the powerhouse of the industrial scene. Seattle was one of the bigger movers this last quarter. There's got a variant there across portfolios. I'll let Robbie maybe comment on that one in a second. Also up there, as we've seen, kind of New York, but also kind of Atlanta, kind of 2 pivotal kind of strategic markets from a logistics standpoint. And then at the lower end, the markets, the further adrift, those ones in the center of the country. So I guess maybe no massive surprises there, Robbie, but I know you did look into the Seattle one, but your just general thoughts of the order that we're seeing there playing out.
Sure. I think over the past 2-3 quarters, I always talk about the sunny Southern California. Guess what? This time, the rainy Seattle is in, right? So this quarter, they're coming up there like 14.4%. Not always sunny, but they're actually catching up like on the return perspective last quarter, right? So what's major changes is kind of in the sense what factual, like the increase in rent. They have a strong net absorption last quarter, right? So if you look at the vacancy, it dropped from a high 3% to a low 3% from quarter-to-quarter basis, right? So vacancy is still higher than Southern California, though, right? In contrast with Southern California, you look at LA, Inland Empire, they're less than 1% now. But I think that movement on net absorption, increase in rent, that impacted the increases in Seattle, right? So the other thing as well, kind of in Southern California perspective, a lot of coastal market generally, right? So there's continued supply imbalance, right? So with inflation story, the constructions basically kind of continue to be delayed, right? So new supply is basically lagging behind the overall demand side, as we indicated, right? So you add on the shortage of labor, regulation, environmental checklist, right? So I think that supply imbalance might continue for a while, right? So in the near term, that's going to basically give a lot of a positive momentum on the rent side for a lot of this coastal market.
Yep. Thanks, Robert. And if we look at to take that step into the appreciation returns and the kind of attribution behind that, here again, the variant on appreciation is really all on the cash flow side, more so than the pricing side. There's a pretty clear alignment there in terms of the hierarchy, in terms of the changes in market rents. Those Southern California markets probably, they're leading the charge again. Increases there in the mid-teens over the last quarter, just a 3-month movement. Compare that with single-digit changes in market rents down below. I thought what the most interesting detail on this slide was the yield change on Inland Empire Riverside, in that there isn't any. So Robbie, guess maybe pricing finally reaching its limit here. I mean, is that an early indication that markets are starting on the industrial side to become, is it called, fully priced, so to speak?
Yeah, I think part of it is basically with the low cap rate transaction, right? So the most buyer are cash only buyer now, right? So and it's kind of harder to continue pushing down the cap rate, right? So the good thing is fundamental continue to go up. It's kind of correlated to one extent as well. So but this time people are a little bit more cautious on the pricing side, while people are still very bullish on the fundamental side.
Yeah, sure. And then just over a 2-year time frame, just to accentuate the top from the bottom end of the order in terms of the cash flow variant, and just to put out those staggering numbers when you look at the movement, market rents Inland Empire, 60% change over a 2-year period, 50% movements in market rents for Los Angeles and that kind of key New York, wider New York market versus some kind of even single digits down the lower end of the order, and then also kind of changes on the kind of rent growth rates to the right hand side there. If you just unpick the kind of year one numbers in those, then Riverside, Inland Empire, LA, New York, they're all in the 6% range, and plus that for the first year. Compare that with Chicago, Denver, Houston, they're still in the 3 to 40% range for those year one growth rates. So there's definitely variability out there on the cash flow side. Onto offices, arguably the most, we might call it complex sector at the moment, and most talked about, aside from that San Diego return, where there's a few really high profile life science assets that are kind of going off the chart there performance wise. It's pretty much low single digit returns at best, and a similar narrative, I guess, to prior quarters in terms of the hierarchy, with certain, I'd call it maybe lifestyle focus or Sunbelt type locations performing better. So good lifestyle, Denver doing better than the average. On the Sunbelt side, definitely that Miami return has been stepping up over the last few quarters. The impact of medical office, life science, certainly bolstering the likes of Boston. We've talked about that before, and also, making actually the last quarter quite a notable impact on that San Francisco return. And then also maybe worth drawing attention to kind of what might be termed the non-primary markets, in that kind of other grouping that are certainly holding their own there as well. Usual suspects at the lower end: New York, DC, Chicago, Houston, LA as well, look to remain quite challenged. So Robbie, your short thoughts on NREL, any kind of shake up in that hierarchy at the moment?
Sure. I think overall, the first thing we kind of surprised is San Francisco, right? So 2.2%. I just talk about how San Francisco return to office is lagging. I was like, what the hell happened, sure. Right? So 2.2. Right, so I think that part of it is basically by digging down into it, that movement are associated to life science building, right? So it's not necessarily your CBD office here and there, it's more your life science building. Yeah. Same exactly as what happened to San Diego, right? So San Diego, Boston. So a lot of life science number that can make the numbers higher. So actually, if you strip them out, the return would have been a lot lower, right? So not a lot lower, will be lower, right? So maybe question to you, Phil. Do you know when NCREIF is going to break out life science from the office?
Yeah, well, $1 million question, but yeah, it was hotly debated and tabled at the last NCREIF just the other month, and my understanding is the definitions have been firmed up. I mean, the majority it will still within that office umbrella, but they'll be able to separate it out. They're tightening up the definitions, but that will allow us to be able to kind of move it out and see the return net of life science on those offices. I believe they're operationally wanting to move forward with this on their Q2 kind of data platform, if that hits time frame. So hopefully in time for the Q3 release. That's the sense of the time frame that I've heard recently. So, but I don't know if others can put something firmer in the chat, but we'll definitely follow up with our friends at NCREIF to get a firmer timetable. On to the breakdown of the appreciation on the office side, and there's definitely kind of two sides here. Certainly when we're looking at the cash flows for the last quarter, feeding into some upside and downside in appreciation. Cash flows on the one side strengthening versus still facing certain headwinds, and those headwinds aren't really in evidence on the face kind of change in market rents and contract rents. They're generally now kind of moving in the right direction, although there is some variability in terms of the stronger markets, seeing more of some of that pickup in market rent at the top. The headwinds down below are more around the continued concessions, the increases in operating expenses, and also that again to that kind of capital cost ratio that I mentioned when we did the sector analysis, and how the levels of budgeted capital expenditure are kind of ratcheting up in what you might call some of the more challenged markets. That's the Q1 kind of assessment. If you break things down on a 2-year basis, then there's clearly a lot more red on the board. Lead markets: Boston, Seattle, there's some sales that feed into that. Those kind of outside the major, the primaries, they're the ones that have really seen kind of any positive pure pricing adjustments, so yields kind of compressing over a 2-year time frame. Elsewhere, minimal impact from pricing, and remember also here we are dropping off the first 3 months of the pandemic. So if you actually took things back, the full 9 quarters to December 2019, most of those yields would be kind of still trending above where they are, where they were at the start of the pandemic. On the cash flow side, we're seeing kind of then on a year more of that variant in terms of the market rents, and also kind of a correlation in terms of the kind of levels those growth rates have been the scale back. And on the downside, those lower markets, the ones that have suffered from a bit more on the vacancies. They've certainly been projecting kind of larger capital expense budgets, a bit more operating expense, a bit more rental concessions, all of which has been turning those kind of appreciation returns negative for the majority of the office markets over the course of the last 2 years. Finally, onto the retail side of things, and looking through a slightly different lens here. When we talk to the clients around their retail portfolios, we have got a sense that it makes more sense to break things down across the different kind of property categories, the subtypes, as opposed to a regional breakdown. But we can do it both ways. But on this basis, that on the left-hand side for the last quarter, values for most of the retail property types recovering some ground in the first 3 months this year. Positive pricing and positive cash flows. So certainly green shoots are emerging, and those destination centres, the super regionals, you'd include within that narrative. The regional, the theme and festival continue to struggle lower down. Your thoughts maybe, Robbie, just on the general state of the retail market, but also maybe the variances that we're seeing here?
Sure. If you look at it, the positive side on retail is retail sales continue to go up in the US, right? So it comes from both e-commerce and brick and mortar, right? So both of them do have increases in sales, right? So and foot traffic in the mall have improved as well, right? So I think that the overall on the grocery side, a lot of where community center, neighborhood center have a lot of grocery anchor. That's doing pretty well. Like if you look at grocery sales is up an average, like basically 5%. If you look at month to month, even grocery sales is up like 8 to 9% since January to March, right? So grocery are definitely doing better. Like investor demand kind of improve as well for grocery anchor. For super regional, I think that the leasing on the trophy asset, the Class A mall, basically have definitely improved, right? So that's why you can see that cash flow kind of effect side versus the non-trophy kind of is kind of continue to struggle, right? So on the leasing front, right? So and investor demand are not back yet for the mall side, but they are definitely kind of you see more transaction in the grocery anchor retail now.
Sure. And actually, if you just kind of break out the cash flow components for those first 3 months, you can see certainly those malls, the regional malls, the theme of festivals, under pressure, further vacancies, rents still under pressure. The super regionals seem to actually be coming out the other side with regard to kind of market rents trending back up. That's the 1 quarter. If you then take a 2-year view of the cash flow movement on retails, then there's clearly a lot more red on the board, and those kind of larger centres down the bottom end, net down in terms of market rents, growth rates, and actual rental levels. As well as breaking retails down by subtype, we can do the same thing for the other property types. Again, this is now, to your point, Robbie, where NCREIF is in the process of redrafting some of their definitions and reclassifying here, especially in the case of the residential, the multifamily sector. But for now, we're certainly seeing, as you'd expect, the stronger returns coming out of the low rise and the garden. They kind of almost intermix those 2 categories, and we've seen the people's where they've been allocated out versus the kind of more urban, the high rise stock, and they're definitely going to break those down into more defined kind of groupings. High rise, I think, is still just 4 floors and up at the moment, so there's definitely better to come out of that. and they'll also be able to break out the student accommodation. We've done a pretty rudimentary exercise in terms of trying to identify the ones that we can. It's a very small pocket. Those numbers here are the percent of the overall ODCE that these account for, so less than just over 0.5%. And I guess, Robbie, there's going to be seasonality, because I was a little surprised to see that student accommodation kind of number coming in a little bit lower than I would have thought. So I guess there's some seasonality there, is there?
Yeah, on student, they generally kind of the leases on when the school start, right? So generally in fall.
Sure.
So you definitely have the seasonality. I mean, you can see already this increased investor demand there, a most recent transaction going on.
Yeah.
So might not see it in first quarter number, but I think that investor demand going to continue to see over the near term basis, right? So and then once you kind of go to the fall season, you might see a newer rent as well coming up from it too.
Sure. And then finally, just on the office market, where they have taken a bit more of a kind of finite breakdown, those suburban secondary business districts. Now, this is the Q1, certainly kind of running ahead of the urban fringe and the downtown market. So maybe any return to work is not significantly moving the needle from a comparative standpoint in terms of those downtown returns, and that shows you just the strength of the storage within that other bracket. Conscious that we're getting kind of towards the hour. I don't know if there's been questions coming through. Rick, you posted some questions at the start. Hopefully we've addressed some of those in terms of just the kind of the narrative back on those points. I mean, it's still an incredibly strong number, I think is the general summary. And while things are easing off a little bit on the yield and the cash flow side, interest rates may be playing into the yield side, but as Robbie, you've alluded to, there's a lot of dry powder out there and a lot of investor pressure in that regard. And the fundamentals with the inflationary story linked to that are still very strong. We have seen a little bit of a tempering down in terms of the returns at the top end of the market. Retails are edging back up again. Offices, really no further forward. But also then we're seeing kind of some movement on some of the gateway when we look to those that evidence on New York. So hopefully that's got to some of the detail that you were looking for, and hopefully it's helpful and insightful for everybody else. Obviously, we'll be looking forward to talking to our clients on a one-to-one basis around these results. But back to you, Rick, in terms of there's anything come through on the chat line on these.
Yep, no, great. Thanks, guys. Yeah, a few questions, and maybe it ties to, we did state, less yield upside for industrial specifically, but especially considering, I believe, overall industrial up over 50% over the last 2 years. So just phenomenal appreciation numbers. And so just to kind of poke a little bit on the other side, a few questions on, so with consumer spending, is what's going to be the impact, if you look at consumer spending backing off a little bit on real terms, if you consider inflation in there, is the actual amount of goods being consumed or purchased, as well as just the post-pandemic opening where a little bit more shift to services as opposed to goods. And again, you would imply less, for industrial. Is that, where do you see that in terms of impacting, or where do our investors or clients see that in terms of impacting demand for industrial?
Yeah, do I look at on that demand side? I mean, first, the vacancy factor in the gateway market are really, really tight, right? You're looking at 0.6. Even just to accommodate today, they don't have enough, right? So, and then with supply chain issue, there's a lot of discussion that basically a lot of retailers have to increase the safety stock, right? So some even, I think Prologis in the earning call indicate they might increase by 10%, right? So that 10%, which means they need more space to that supply stock instead of just in time, just in case we talk about, right? So, but now supply chain is going to go longer. They need to find that space, right? So, and if you look at it, the total new supply is about 3.4% of inventory in the United States, right? So our occupancy in industrial is 97-something%, right? So even and then a lot of that space is under construction already leased as well, right? So you don't have enough space as it is today. While this might be contraction on the demand side, you will look at it with retail have to increase the space. You're going to have increase that demand side on the space perspective, right? So I think that the overall is still have a good kind of what I call it. There's a lot of good fundamental basically in the industrial. I understand as well, like Amazon, a recent earning call indicate they they have too much space, basically, right? So they might reduce the leasing going forward. But if you look at it, like the existing fundamental, where the new supply is coming in, right? So you still need a lot of space to just getting back to normal.
Yep. So still the demand there is just, or the supply there is still trying to catch up to the demand that. Okay, great. You mentioned Seattle really shined this quarter, was sunnier than California. On the industrial side, is it some of that due to, I know the port delays in the LA harbor here have abated, have slowed, and I think somewhat due to the shutdown over in China. But has Seattle benefited from any shift? Have you heard anything shift of that traffic, more to other ports like Seattle?
It is for sure as well. So the other thing as well, even you go to LA, there's no space to store them, right? So even you abate in LA, like in Inland Empire, 0.6%, Southern California, 0.9% vacancy, there's not enough space to go there, right? So you have to shift some of the stuff to up north, right? So, and where the vacancy in Seattle, or like in the beginning of the year, is 3.9%. Still a lot better than the Southern California, right? So you can see that movement associated there as well. And the rent are more reasonable compared to the Southern California area, right? So you get that benefit on that side as well.
Okay. Maybe Phil, if you want to go to slide, I think it's slide 10 and then we'll 10 and 11, just, so again, sticking with the industrial. So not only do we continue to see substantial, increases in market rent and that's impact on the cash flow effect of the appreciation, but at the same time you see market rent growth continuing to increase. And so, at the bottom there, 5.4, 4.7, just phenomenal, expected rent growth, even though we've had significant rent growth. Is industrial getting ahead of, over the skis a little bit, just in terms of where rents are and expected to continue to grow at I can't say above inflationary rate anymore, but above a more average rate, or is it again just tied to the catch up in supply in the markets?
For me, when we look at these numbers and we look across portfolios, I mean, there aren't outliers, so it feels like everybody is taking the same opinion around these. So just in defence of those levels, in terms of whether it will play out, I'm not kind of here to kind of comment forward towards that. But I mean, these are levels that we see similarity across the portfolios. Obviously, there's regional variances within those numbers, but yeah, it does feel that everybody is in general agreement in terms of those levels going forward.
Yeah, and then to add as well, right? If you look at public REIT earning call, right? So they talk about the lease spread. The lease spread is pretty amazing as well. Even quarter-to-quarter number is actually higher than the number that we have in here, right? So, and a lot of analysts projection on kind of the more market rent for the industrial, actually even higher than this number in here, just because the supply imbalance that the people anticipated, like it's just not fast enough, right? The new supply are not fast enough to catch up to the demand side.
Okay. Maybe shifting to apartments. Now mortgage interest rates, gone from 3% to over 5%. So while it doesn't seem to have impacted housing prices yet, I think the expectation is it'll at least slow, just given the higher cost to borrow money to buy homes. What's going to be the impact to apartments? Is that actually a positive impact to demand to our apartments, where would-be home buyers may have to continue to rent or actually go back to renting?
Yeah, it is going to be a positive impact based on our discussion with a lot of our clients, right? So because it's hard to come up to the down payment to get a house to begin with. Right now, the mortgage payment is increasing as well, right? So which means affordability, the home price is not too elastic. It doesn't drop right away, right? So, but the mortgage cost is increasing, you immediately impact right away, right? So affordability is tough to own, to basically own. So you're going to have a lot more demand on renting, right? So that's why, like, a lot of investors believe, even though mortgage rate is kind of high or will kind of continue to increase, but on the lease perspective, apartment lease term are short, right? So you're talking about 1 year lease term, so they'll be able to increase the rent just because basically there's a lot more demand for the apartment, for just rental unit, right? So yeah, that's fine.
Okay. Hey, Phil, I think I ask this every quarter, or someone asks it every quarter, and you might have already said this, but how much did development assets impact, add or subtract to the overall return, value add or development assets?
Yeah. So it's there really. It's the 30 basis points upside there. We haven't got that broken out by sectors, but I think most of that upside is on the industrial sector. They're just over about 5% of the overall value in terms of the Odyssey is picked up through coded up development assets, and that's 30 basis points. Obviously, you can see how that kind of opens things up a little bit more on an annual basis. But yeah, it's and we can definitely kind of run those slides where we look at the table across the returns overall versus stabilized, because you will see some movements in certain pockets. But yeah, averaged out, it's about a 30 basis point premium, which is kind of consistent with what we've been seeing historically.
Yeah, okay, good. Maybe I think we're about out of time. Maybe just quick last question on the office side. San Francisco, slower to return to the office. Is that indicative of more of a longer term trend, or is that just San Francisco a little slower to return versus other markets?
I think combination of both, right? So because like a lot of cases, even even in anywhere, like basically first quarter did pick up, it appeared to stall a little bit right now as well, right? So there's a lot more hybrid spaces, and if you look at it, a lot of the office of long-term leases, so in terms of payment, it's not an issue today, right? So, but it's still the uncertainties, like how many square footage people will need when the lease expired, right? I think there's still a big question mark. I think not only San Francisco, I think it's basically all the CBD market, right? So we saw a lot of leases on the trophy asset. There's no question there, right? So, but anything that's not trophy, what did that kind of look like? There's still question mark there.
Right. Okay. Well, I think that's all the questions as well as time that we have. Phil, Robbie, thanks again. Thanks everyone for joining this quarter. We will be sending out a recording of this, I believe early next week. And again, August 4th is the next session. We'll be sure to color coordinate our shirts again next session. And thanks again for everyone for attending. We'll see you.
Thank you very much, Juan. Thanks a lot.
Thank you.